So you're probably seeing all the headlines, right? The next big tech IPO, the latest AI breakthrough.
Yeah, absolutely. Everyone's focused on growth.
And look, that makes sense. But what if there's something else? Something really interesting the market's kind of missing right now?
A different kind of opportunity, perhaps.
Exactly. Like a chance to maybe snag some, well, surprisingly high and, dependable returns.
That's right. While everyone's chasing that high-octane growth, there's this other area offering something pretty rare today.
Which is?
Substantial, reliable income. We're talking yields well north of 11%.
Okay, 11% plus. Now, I know what people are thinking. High yield, high risk. That's the usual equation.
And you should be cautious, absolutely. But this isn't about super speculative stuff or companies just barely hanging on.
No junk bonds here.
No, not at all. We're looking at solid, established businesses, real cash generators.
So what's a mission for this deep dive then?
Okay, so the current market narrative, it's really all about interest rates, right?
Right.
That fear. It's created this disconnect.
A disconnect.
Yeah. Fundamentally strong companies, good cash flow, but they're being undervalued. So our goal is to explore that, why the market seems to have missed this, and importantly, where you might actually find these opportunities.
All right, let's unpack that. This market blind spot. What's the core reason it exists right now?
It really boils down to the higher interest rate environment. I mean, you got short-term treasury bills yielding around 5%. Pretty safe.
Yeah, decent return, low risk, people like that.
Exactly. So there's this gravitation towards that safety. And that, in turn, it puts pressure on other things that generate income.
Like what kind of things?
Well, you're seeing it in sectors like real estate, energy pipelines, the midstream companies,
Okay.
business development companies, BDCs, and also especially finance. The market sort of paints them all with the same brush.
Assuming they're all just getting hammered by higher rates.
Pretty much. There's this assumption that higher rates are universally bad for these sectors. Call it maybe rate myopia, just focusing on that one factor.
But you're saying that's, well, too simple.
Definitely too simple. Here's the thing, and this is key. The impact of rising rates isn't the same everywhere.
Oh, okay.
Many of these companies actually have business models that make them pretty resilient. Some, believe it or not, even benefit
from higher rates. How?
We'll get into the specifics, but yeah. And it's this gap in negative perception versus the underlying reality that's creating the potential opportunity.
Okay, so there are opportunities. But how do we avoid falling into a trap? You hear high yield, and sometimes that means the company's in trouble. What's the difference between a genuine value yield and a value trap?
That's the million-dollar question, isn't it? A genuine value yield is basically a sustainable payout from a financially healthy company that just happens to be undervalued by the market right now.
Okay.
A value trap looks good on the surface, high yield, but it's coming from a company with real fundamental problems. The payout isn't sustainable.
So you could see that dividend get cut.
Exactly.
Yeah.
Chasing the absolute highest number without checking under the hood. That's risky. Selection is critical.
Got it. All right, let's tackle some of the big ideas, the misconceptions floating around. First one. High interest rates will destroy everything. Why isn't that always true?
Right. It's just too broad. The effect really, really depends on the specific business model. I think energy pipelines.
Okay, the midstream guys?
Yeah. A lot of their contracts, these are long-term deals, they have inflation adjustments built right in.
So if inflation's up, their revenue goes up.
Basically, yes. It acts like a natural hedge. Now, think about BDCs, business development companies. They mostly lend money at floating rates. So when the Fed hikes rates, the interest they earn on their loans
Also goes up.
exactly. It boosts their profits.
Yeah.
Kind of counterintuitive, but higher rates can be good for their bottom line.
That is interesting. You wouldn't immediately think that.
No, you wouldn't.
Eh.
And even with REITs, real estate investment trusts, some have locked in cheap debt years ago, and their leases might have rent escalators tied to inflation.
So the market just lumping everything together is a...
Well, lazy. It's a bit of lazy analysis, yep. It misses these really important details, these nuances between different companies and sectors.
Okay, misconception number 2. All dividends are about to be cut. How realistic is that fear?
Look, some dividends do get cut in downturns, that's true, but it's absolutely not a universal thing, especially not for higher quality companies.
What makes them higher quality in this context?
Well, they tend to manage their payouts more conservatively. They have lower payout ratios.
Meaning they keep more cash, pay out less as dividends.
Right. They're not stretching to make the payment. They usually have more stable cash flows too, less sensitive to the economy, and stronger balance sheets.
And these 11% yielders we're talking about.
Many of them have really strong dividend coverage, and we're talking generating 2, maybe even 3 times the cash they need to pay the dividend.
Wow, 2x or 3x coverage?
Yeah. So for every dollar they pay out, they're bringing in $2 or $3 in cash flow. That's a significant buffer.
A cushion.
A big cushion. It lets them maintain that payout, even if earnings take a temporary hit. Investors seem to be overlooking that safety margin right now.
Okay, last big misconception. Nobody wants real assets anymore. Everyone's just obsessed with tech. Right?
Well, the tech excitement is definitely there, and it's understandable.
Yeah.
High growth potential.
Yeah.
But don't discount the stability and reliability of, boring real assets. Things like real estate, pipelines, infrastructure, they generate consistent income.
And they have pricing power.
Often, yes. Especially when inflation is high. People still need energy moved, places to live, places to work. It's fundamental.
So the fact that they're not the flavor of the month right now.
That actually creates the opportunity for income investors. Less competition, better prices sometimes.
Okay, this is great context. Let's get specific. Where can listeners actually find these double-digit yields? Let's start with energy pipelines, midstream MLPs.
Right. So this sector, you're typically seeing yields, say, 7% to 11%, maybe a bit higher in some cases.
Any examples?
Think companies like Enterprise Products Partners, ticker EPD, or Plains All-American Pipeline, PAA. Solid players.
And why the high yields there? Still the rate fears? Or something else?
It's partly rate fears, but also longer-term concerns about fossil fuels. The energy transition narrative.
But demand is still strong now.
Demand is strong, especially for exports. And crucially, these companies mostly operate on long-term contracts, fee-based.
Ah, the toll road model you mentioned before. Explain that again quickly.
Sure. It's like they own the highway for energy. They get paid for the volume of oil or gas that moves through their pipes, not necessarily the price of the oil or gas itself.
So less commodity price risk.
Much less direct exposure, yeah. They're charging a toll to move the product. Take EPD, Enterprise Products Partners. Rock-solid balance sheet, inflation protection in many contracts, and they've raised their distribution, the MLP version of a dividend, for over 25 years straight.
Impressive track record.
It is.
Right.
And yet its yield is over 7.5%, and some smaller solid peers, they're yielding over 10%.
Okay, interesting. Let's move to business development companies. BDCs. What's the yield range there?
BDCs are often in that 9% to 13% yield territory, maybe even higher sometimes.
And who are the main players people might know?
Well-known ones include Ayers Capital, that's ARCC, Main Street Capital, Maine, and Owl Rock Capital, ORCC.
And market's worry here is loans going bad.
Pretty much they lend to small and mid-sized businesses, so the fear is defaults if the economy slows down significantly.
Is that fear overblown?
Well, the good BDCs are well-diversified. They have careful underwriting. And remember what we said about interest rates.
Ah, the floating rates. They actually benefit from higher rates.
Bingo. The vast majority of their loans are floating rates. So as rates have gone up, their net interest income, their earnings, have generally increased.
So profits up, but stock prices haven't kept pace.
In many cases, yes. That's the disconnect. Main Street Capital, for example, strong dividend coverage, often pays supplemental dividends too, yielding near 9%. Owl Rock, ORCC, often yields 11-12%, again with solid coverage.
So the very thing the market fears rate hikes is actually helping these guys. Paradoxical.
It is, assuming they manage their credit risk well, which the top players tend to do.
Okay, next category. Specialty finance. Yields.
Often similar to BDCs, maybe 10% to 12% is a common range. Think companies like Hercules Capital, HTGC, or PennantPark Investment, P&NT.
And the market concerns are similar too. Rate fears, credit worries.
Yes, very similar dynamics to BDCs. Interest rate sensitivity fears, worries about the health of the businesses they lend to.
Do they lend to different types of companies than BDCs typically do?
Sometimes. Many specialize in certain niches. Hercules, for instance, focuses a lot on venture capital-backed tech and life science companies. PennantPark also has specific strategies, but the key structure is often similar. Senior secured loans, floating rates.
So they get that same potential benefit from rising rates.
Correct. If they underwrite well, higher rates can boost their income streams.
All right, finally, REITs. Real estate investment trusts. You mentioned being selective here. What yields are we seeing and what's the caution?
Yields can be all over the map in REITs, but the ones hitting these higher levels, say 8% to 12%, often face specific concerns. We mentioned Medical Properties Trust, MPW, or Global Net Lease, GNL, as examples sometimes in this range.
And the concerns are recession fears, tenant problems.
Both. General worries about the economy hitting tenants, plus specific issues depending on the property type. Healthcare REITs worry about hospital operator finances. Office REITs worry about remote work. Retail REITs worry about online shopping.
You brought up MPW, Medical Properties Trust, owns hospitals, right? What's the story there?
Yeah, they own the physical hospital buildings and lease them out long term. There have been some very public concerns about the financial health of a few key tenants.
And the market reacted strongly.
Very strongly. Pushed the yield way up into that 11-12% range at times. But the crucial thing to check is their cash flow funds from operation, or FFO. Does it still cover the dividend?
And for MPW, you're saying it appears to.
Last I checked, their reported FFO seemed to provide adequate coverage. But, and this is a big but for REITs,
due diligence is paramount.
absolutely critical, especially with high yielders. You need to dig into rent collections, tenant health, debt levels, debt maturity schedules. An industrial REIT owning warehouses is facing a totally different world than an office REIT right now. Can't just chase the yield number.
Okay, that's super helpful detail on where to look. Now, for listeners thinking, okay, I'm interested, what's the game plan? How should they approach this strategically?
Right, a sort of battle plan. First rule, diversify. Please don't put everything into just one company or even one sector.
Spread the risk.
Exactly. Maybe think about an allocation like, say, 40% pipelines, 30% BDCs, 20% specialty finance, 10% in some carefully chosen REITs. Just an example mix.
Got it. What's next?
Second, focus relentlessly on dividend coverage. Is the cash flow comfortable covering the payout? Look for at least 1.2x coverage, ideally higher, and check the history. Have they maintained or grown dividends through tough times before?
Look for resilience. Okay, third point.
Debt. Pay close attention to debt levels. How much do they owe? When is it due? Do they have enough cash or credit lines available? Favor companies with manageable debt.
Makes sense. Less risk if things get bumpy. And finally,
Think about reinvesting those dividends. This is where the magic can happen. An 11% yield, reinvested, it compounds powerfully.
how powerfully?
Well, just basic math.
Yeah.
You could roughly double your money in about 6.5 years just from the reinvested dividends, even if the stock price goes nowhere.
Wow, just from the yield compounding.
Yeah, and if the market eventually wakes up and these stocks re-rate higher, then you get price appreciation on top of that. Potential for really strong total returns.
Okay, but we need the reality check too. What could actually go wrong? What are the main risks here?
Good question. There are definitely risks. A deeper, nastier recession than people expect. That could hurt BDC and specialty finance borrowers, leading to more defaults.
Okay.
Regulatory changes are always a possibility. New rules for pipelines, new regulations for financial firms, that could impact profits.
Company-specific stuff too, I imagine.
For sure. Bad acquisitions, management missteps, fraud, though hopefully rare, or major tenant bankruptcies for a REIT. Stuff happens.
So how do you protect against that?
It comes back to those core principles: diversification, focusing on quality, strong balance sheets, good dividend coverage, and monitoring your investments. Don't just buy and forget.
But overall, you feel the risk versus reward is tilted favorably right now.
Given the current yields and the underlying cash flows of many of these well-managed companies, yes. I think the market pessimism has created an attractive entry point for informed, careful investors. The risk seems well compensated by the potential reward.
Okay, so let's pull this all together. The main idea is the market's kind of freaked out about interest rates.
Right, that anxiety is high.
And that fear has pushed down the prices of some fundamentally solid companies.
In sectors like pipelines, BDCs, specialty finance, some REITs.
To the point where they're offering these unusually high double-digit yields. It's like, the baby got thrown out with the bathwater.
That's a pretty good way to put it, yeah. The market seems to have overreacted in many cases.
And the key is, this isn't about chasing yields from companies about to go bust.
No, absolutely not. It's about identifying solid, cash-generating businesses that are just out of favor right now, creating a, frankly, rare buying window at attractive valuations.
A window that might not stay open forever?
Probably not. If and when the market sentiment shifts, or if rates stabilize or even come down, you can see these assets reprice higher and those juicy yields compress.
So it could be time sensitive.
I think so, yes, for those willing to do the homework.
So the message for listeners is, maybe look beyond the shiny growth stocks for a minute.
Yeah, peel back a layer.
And consider these maybe overlooked, corners of the market generating serious income.
Exactly. Do your own research, prioritize that quality, the dividend coverage, the manageable debt. Think about diversification.
It's definitely food for thought. Potential double-digit returns from established businesses isn't something you see every day.
It certainly isn't typical in most market environments.
Which brings us to maybe a final thought to leave people with. What does it say about the market, maybe longer term, if it consistently gets drawn to, the hype?
The next big thing.
While maybe overlooking this kind of fundamental value and reliable income, what are the implications of that pattern? Something to ponder.